You have $1,000 to invest. Last year, Metro Coffee made $100 million in profit with an EPS of $1 and trades at $70 per share, while Daily Brew made just $10 million with an EPS of $2 and trades at $49 per share. Which one should you choose to invest in? Most people will pick Daily Brew because it has better earnings per share. But that could be a huge mistake if we don't take stock price into account. This is exactly why investors use the price to earnings ratio. Hi, I am Nick, a long-time value investor and financial educator. By the end of this video, you'll know exactly how to use PE ratio to avoid costly mistakes like this one. The PE ratio tells you what the market is willing to pay for each dollar of the company's earnings. It is calculated by dividing the stock price by the company's earnings per share. And if you skipped the earnings per share video, watch it first. PE only makes sense when you understand the denominator. Click on the link here. Here is the formula. PE ratio is equal to stock price over earnings per share, or EPS for short. Let's apply this to our two companies. Metro Coffee, $17 stock price over $1 of EPS, PE of 17. Daily Brew, $49 stock price over $2 EPS, PE of 24.5. The PE number is called a multiple or earnings multiple. So you might hear investors say Metro Coffee is trading at 17 times earnings or Daily Brew has a multiple of 24.5. It's all the same thing, just different ways to express the PE ratio. Here is what this means. For every dollar Metro Coffee earns, investors are paying $17. For every dollar Daily Brew earns, investors are paying $24.5. That's 44% more expensive for the same amount of earnings. Here is another way to look at it. Assuming earnings stayed constant, it will take 17 years for Metro Coffee to earn back your investment and 24.5 years for Daily Brew. Of course, earnings rarely stay constant, and neither does the stock price. That's why PE ratios change constantly. Stock prices move every day and companies report updated earnings figures every 3 months. Right now, Metro Coffee at $17 has a PE of 17. But if the stock jumps to $30 next month, while earnings stay at $1 per share, the PE ratio becomes 30, suddenly making Daily Brew the better value at 24.5. This is why smart investors track PE ratios over time and compare them to historical averages. A single snapshot can be misleading. They ask, is this company's PE higher or lower than its usual range? Did it change because of price movements or earnings changes? And is the current level justified? Now, Metro Coffee and Daily Brew are both coffee companies, so comparing their PE ratios makes sense. They operate in the same industry with similar business models and growth expectations. But here is where many beginners make a critical mistake. They compare PE ratios across completely different industries. Let me show you why that's a problem. Imagine you are comparing Daily Brew's PE of 24.5 to CodeStream, a software company with a PE of 45. Daily Brew looks way cheaper, right? Wrong. Daily Brew is a coffee chain, physical stores, steady growth around 10% per year. The average PE for coffee retailers is about 18. At 24.5, Daily Brew is actually expensive for its industry. CodeStream is a software company growing 60% per year. Software companies typically trade at PE ratios of 40 to 60. At 45, CodeStream is actually cheap for its industry. Same ratio, completely different meanings. The rule: always compare PE ratios within the same industry. Otherwise, you are comparing apples to oranges and you'll make costly mistakes. So, based on the PE ratio alone, Metro Coffee at 17 is the better value compared to Daily Brew at 24.5. you are paying less for each dollar of earnings. But PE alone isn't a reason to buy a stock. It is a tool for comparison, one of the many an intelligent investor uses. But now let's look at some real companies to see how this works in practice. Two of the most famous rivals in business history are Coca-Cola and Pepsi. Both are beverage giants. They sell similar products, have global brands, and operate in the same industry, which makes them perfect for a fair comparison. To gather the financial numbers we need, I am using QuickFS, a great free tool for investors. You just search for the company you are interested in using the ticker symbol, KO or PEP. All the current data we need is here. Coca-Cola trades at a current price of $68.51. The reported EPS for the last completed fiscal year 2024 is $2.46. If we calculate the PE ratio using that EPS, we get PE is equal to $68.51 over $2.46 is equal to 27.8. Pepsi's stocks trade at $142.86 and the EPS for 2024 was $6.95. So the PE ratio is 20.55. This means investors are paying around $27 for every dollar of Coca-Cola's earnings and around $20 for every dollar of Pepsi's earnings. So on the surface, Pepsi looks significantly cheaper relative to its earnings. Comparing Coca-Cola and Pepsi is correct. They are in the same industry, selling similar products, which makes their PE comparison meaningful. Now let me show you what happens when you ignore this rule. Let's compare Pepsi to Ford Motor Company, a comparison that seems reasonable on the surface, but is actually meaningless. On the surface, Ford's PE of around 9 looks way cheaper than Pepsi's 20, so it might seem like Ford is the obvious bargain. But that's not how valuation works. Ford isn't actually cheaper, it is just a completely different kind of business. Pepsi operates in the consumer staples industry, things people keep buying no matter what the economy does. That stability makes earnings predictable, so investors are willing to pay a higher multiple for that safety. Ford, on the other hand, is an auto manufacturer, a highly cyclical business. Profits rise sharply when the economy is strong and drop fast when it slows down. Because of that risk, investors demand a much lower PE ratio. While Pepsi's PE of 20 and Ford's PE of 9 look very different, both are actually fairly priced for their own industries. Comparing them isn't just misleading. You are comparing apples to engines. But if we compare Ford to Tesla, now the comparison makes sense because both companies operate in the same industry, automobiles. Here is where things get interesting. Ford trades at a PE ratio of around 9, while Tesla's PE sits around 304. Yes, you read that right. That's more than 30 times higher. Is Tesla wildly overpriced? Not necessarily. The difference comes down to growth expectations. Ford is a mature, slow-growing automaker. Investors don't expect its profits to rise dramatically in the future, so they aren't willing to pay much more than 9 times earnings. Tesla, on the other hand, is priced for massive future growth. Investors believe its earnings will keep expanding quickly for many years, so they are willing to pay a much higher multiple today. That's what the PE ratio really reflects, not just how profitable a company is right now, but how profitable investors expect it to become. But as we saw with Ford and Tesla, the PE ratio alone doesn't tell the full story. To get the real picture, we need a way to factor growth into the equation. That's where the PEG ratio comes in, and that's exactly what we are covering in the next video. I am going to take these same two companies, Ford and Tesla, and show you how to use the PEG ratio to figure out which one is actually the better investment. So click on the card here to watch that video next.